Welcome to Forex Conquered trading course. My name is John Person. The purpose of this course is to teach you the basic fundamentals and advanced techniques for successfully trading the Forex or foreign currency markets. This course is not going to teach you to pick every top and bottom of every single price move. What this course is going to try to do is teach you how to find and identify specific technical formations that have a time-proven history of being profitable. We've run back tests on some of the methods that we are teaching in this course, and they have a statistically proven strong success ratio. As soon as you will discover that some of the charts, in fact, the back tests were done in this course with the Genesis trading software. Throughout this course, I do refer to the Genesis software platform and also the plugins that I have developed based on the methodologies taught that you have in this trading course. So there is a link on my homepage at www.nationalfutures.com if you would like to try this software for a free 30-day trial with the plugins. I highly recommend that you try this software if you don't already own it. I welcome you to joining me in a fascinating journey of trading in the markets for a living, and I wish you the very best that life has to offer. With that, let's get started with our program. First off, this is copywritten information. What you see here is for your eyes and for you to benefit from trading. This is educational material to teach you what it is for successful identification of technical analysis patterns. It's unlawful to reproduce, distribute, or exhibit this material to anyone other than the individual assigned. You cannot reproduce this material without express written consent of the author, me, John L. Person. First off, I'd like to point out that some of the things that many people have seen is my trading book, The Complete Guide to Technical Trading Tactics, How to Profit Using Pivot Points, Candlesticks, and Other Indicators. This is one of the first books ever to be written on combining pivot points and candlesticks. In fact, we had many people give us strong recommendations on this book and endorsements, such as John Murphy, Larry Williams, Larry Pesavento, Steve Nissen, and also Dan Graham's and, of course, Ed Dobson. This book has helped pave the way for other educators educating people in the art of candlestick and pivot point analysis. In fact, in Perry Kaufman's new trading systems method, it's the 4th edition, he quotes my work on page 121 on how important it is to combine candlesticks with pivot point analysis. So this is methods that people have truly adapted to, and it is a very good, solid trading methodology. What this trading course, what we are going to go over, is pretty much a lot of stuff in your trading manual, but we're going to give you some great examples and talk about each one of these topics, such as I'm going to introduce you about the differences. There's some subtle differences and there's some different nuances between Forex and futures. Most people are not aware that we've been trading foreign currency trading markets in the futures industry for literally close to 30 years. We're going to go over pivot point analysis, the importance of confluence, moving average, and a concept of using a moving average with pivot points. We'll go through the construction of candlestick charts, the doji, the specific trade setups such as my signature high close doji, low close doji, and a failed doji top. We're also going to go through some top reversal patterns and show you what it is, especially with shooting stars and also hammer formations. In fact, we'll go through a statistical backtest study that we used using the Genesis software for you to see the importance of why we look at 15-minute charts and why we set up identifying certain candle patterns. We'll go through the benchmark, my signature benchmark, or we call it the blast-off candle, and what triggers a trade based on that formation. Chopstick patterns, otherwise known as yin and yang. Otherwise, some people call them tweezer tops and tweezer bottoms. We'll go through sideways patterns, stochastic signals, MACD setups, Fibonacci extension, and corrections on how you can integrate those on an intraday time period, especially as they line up with pivot point analysis. I'll also show you how to read the Commitment of Traders report, and of course, we will go through how to set up your charting system and so that you can develop the proper trading setups before you begin in your journey on Forex trading. I'd like to introduce to you this phrase by Jesse Livermore because it was written close to 7 years ago, and it is so close to the truth still to this day. It goes like this. There's nothing new on Wall Street or in stock speculation. What has happened in the past will happen again and again and again. This is because human nature does not change. It is human emotion that always gets in the way of human intelligence. Of this, I am sure. Friends, I have news for you. That is so true. If you're watching this video, think of all the time that your emotions, your excitability, your fear, your hope, your greed got in the way of making a rational decision, a clear, concise, well thought out plan. Most times, it is our human emotions that get in the way of our human intelligence. Another favorite phrase of Jesse Livermore's that I firmly believe in is that, and I quote, "All through time, people have basically acted the same way in the stock and commodity markets as a result of greed, fear, ignorance, and hope. That is why the formations and patterns recur on a constant basis. The patterns the traders and technicians observe are simply the reflections of human emotional behavior." And that is such a true statement. In fact, we will go through and show you time and time and time again how formations and patterns reoccur. What is the only difference is what the outcome of those patterns are. We don't know if with one of my signature setups, such as the high close doji pattern, if you're going to get a 30 pip rally or a 300 pip rally. We don't know what the outcome is on each signal, but the patterns reoccur. The results are just different. So what we're going to teach you in this trading course is how to identify those patterns and how to trade those patterns successfully by using risk management, stops, of course, and certain profit objective targets. Now, many of the techniques, ideas, and principles that we will go over in this course deal with simple concepts that many people try to make more difficult, and then of course it becomes more complicated. Issues such as selling resistance and buying support will be illustrated in various fashions. And that is such a simple concept. Remember, we're looking to sell high, buy low. We're looking to sell resistance and buy support. There's many times where people look to try to get real fancy and try to look at getting more out of what a particular trade may give, or they look to try to make all types of fancy breakout patterns. And truth be known, if you just wait patiently, and if you're disciplined to look for the formations and apply your strategy, you will have a much more, at least an easier time at trading, and probably a much better result-driven opportunity if you just follow the plans. So look at selling resistance and buying support. That is going to be, number one, the most simple but yet complicated approach to trading. The tools and techniques that I'm going to teach are absolutely going to help you stay focused and grounded on these concepts. Let's go into Forex versus futures. Trading Forex offers leverage, and of course leverage that the individual can control. You can increase your leverage, decrease your leverage through the use of margin. An individual investor has the choice, of course, to accept the responsibility. With every risk comes reward. The higher the risk, of course, the higher the reward. So with Forex, you can even decrease your leverage. You can decrease your size of what you're trading. You can go through either a 100,000 lot size, a 10,000 lot size. You can increase or decrease your amount of contracts and lot sizes. In fact, you actually have the ultimate control of your trading plan. Now, futures, we also have lower contract sizes, such as you have the S&P 500 futures contract, which is a stock index futures. The full-size contract, every point is $250. And then there's the E-mini contract, which is 1/5 of that size, which is $50 a point. There's, of course, the Chicago Board of Trade's mini Dow contract, where every Dow point is $5. So 100 points in the Dow, and we've all seen the stock market move. And you hear the Dow quoted in the media almost every day in one form or another. It's given reference to. It's the oldest reference stock index contract there really is. And so when you listen to the media and you hear that Dow was up 80 points today, or the Dow was up 100 points today, When you trade a small contract in the Dow, you're trading literally $5 per point. So on a 100-point range day in the Dow, you're talking $500 range. There's silver, there's gold, there's grains. There's all types of electronic contracts and also contracts that have reduced sizes. And these products also have options, which we'll cover a little bit later, but as some Forex companies now are offering some optionable positions on foreign currency trading. But as far as futures is concerned, it is more just like Forex. It's short-term in nature. Trades last from as little as possibly 1 minute or less to 1 week, up to as much as 3 months for most traders, based on a quarterly ending cycle in the futures for most products. And we'll show you about that. That's called the rollover. With the foreign currencies, I got news for you. The futures is a little bit more complex. Futures does offer day trading, swing trading, and position trading opportunities through the use of course, margin and even options to hedge your risk. Forex, it is more geared towards day trading and possibly swing trading 2-3 days. Therefore, in day trading, we need to apply momentum techniques, technical analysis, and that is what we're looking to employ for our bulk of trading in the Forex market. So if you're a Forex trader, you're just looking to capture a move in the market, you're looking to profit from that move, and you're looking to take the next opportunity as you see. Now, no speculative investment is safe, whether it's futures or Forex. So first off, all leveraged investment and even non-leveraged investment vehicles are risky. So it was once told to me that your safest investment is in yourself, in your own career. So whatever that career is, and if you're not yet a professional trader, then remember, using Forex is a great means to supplement an income, or at least to get yourself into taking control of your financial destiny by looking at other opportunities as far as investments are concerned. As far as futures, remember, they have margin calls, and you also in futures run the risks of what's called debits. You can actually lose more than you invest through various market conditions. In Forex, there's also risks inherent with trading with the leverage system, but due to the fact that the foreign currency markets and the interbank market is so vast and so deep and the liquidity is so high, running a situation where you're going to run a debit is so remote that under most circumstances you could literally be taken out of the market in a moment's notice. And most foreign currency platforms have that feature known as a kill switch, so to speak. Now, Forex has uniform contract sizes, and that's one of the neat things about Forex. In fact, analytically speaking, Forex is really better to trade than the futures for first-time startup traders. In fact, the reason I say that is this. Number one, as I just mentioned, all contract sizes are uniformed. In the futures, different various contracts and markets have different contract sizes, and therefore every tick or pip value is different. As we have in your trading course, we've listed the different markets and why they're different, but and at different pricing, such as, for example, Canadian dollar in the futures, $10 per point. The euro currency is $12.50 per point. You have the British pound, which is $6.25 per point, and that trades in half tick or double tick increments. So already, as you can see, it's a little bit confusing. How many contracts do I need? What's my margin? These are things you have to figure out. Trading, your main focus should be, I have a signal, where should I get in, what's my risk, and what's my profit objective. With the futures, you need a little bit more study and involvement in actual knowledge of what the market and the contract sizes are. Another thing about Forex that is truly a great benefit is that we don't have what's called rollover. Every quarter we see a new contract begin, such as we call the rollover period, which takes place the second week of every June, September, December, and March. In the futures, we're trading a March contract, and then as we get through the second week of March, generally speaking, about the second week of March, we have to roll over from a March futures contract to the next quarterly ending cycle, which is the June contract. As we get to June, then roll into September, September, roll December, and then once December passes, we go into March. Now, why is that such a problem? Well, if you're doing technical analysis, number one, every month out in the futures, the difference between futures and spot, there's always a price difference, and it's called the basis, because you're going to have what's called a carry charge. And every product has a carry charge. But with the Forex, it's a continual marketplace, so you don't have that rollover. You're trading in the actual spot market, so you don't have to figure out your technical analysis. You're not going to have those gaps in the chart. We go into detail in your manual, so please refer to your manual on this rollover point. Now, day trading mini lots, in my opinion, is a little bit more advantageous for the smaller retail or individual investor like yourself, especially through Forex. Number one, you can scale into multiple positions, and as the market starts to prove you're on the right side of the track, you can adjust your stops, your risk management. You can scale out by taking some off the table and letting the balance of your position ride. So by trading mini lots, it's a little bit more advantageous for individual investors, especially as not everyone's going to be as wealthy as J. Paul Getty or, in fact, as Warren Buffett. So in trading in the markets, such as with the Chicago Mercantile Exchange, I think the futures contract, they do have mini-size contracts, but these mini-size contracts are just way too, they're not as liquid in the marketplace. There's not enough bids and asks. The spreads are too wide, and it's something that if you're going to be trading, you want to know that if I can get into a product, boy, can I get out of the product. So I think that trading anything less than $100,000 size Forex lots, if that's what you're trading, if you're trading less than 100,000 lot size, then you need to be with Forex. If you're trading like a hedge fund where you're trading millions of dollars every day, and you're trading maybe 10, 20, or 100 lot of the 100,000 lot, you may want to consider a futures position, because with the CME, with the futures contracts, especially during U.S. trading sessions, number one, think of this. The contract is a bigger size. It's 25% bigger. It's actually, instead of 100,000 lot standard size, it's 125,000. So you get a little bit more bang for your buck trading on futures. But that's someone that would be a hedge fund trader who's trading millions of dollars. But if you do that, remember, you're going to have to make up for that rollover period. You're going to have gaps in your chart analysis as you go from one continual month, let's say from March to June, from June to Sep. There's going to be that basis difference, and you're going to have to recalculate your price differences. So you need to identify yourself as a trader. And if you're a day trader, even a swing trader or a position trader, how big of an investor will you be? Those are the kind of questions that are going to help you decide which trading vehicle to use. For most retail individual traders, you're a day trader, number one, you're trading smaller lot sizes, then you need to stick with Forex markets. Now, since Forex does offer ultra mini size accounts that still offers leverage, the greatest thing there is that you can actually put money on the line, not be at severe risk. You, again, won't make a whole lot of money when you're right with these ultra mini size accounts, but here's one thing that has an advantage. You can test any type of trading system and see how you as an individual react to the marketplace with real money on the line. And being able to test and check your emotions while you're trading and checking out a system, that's the true benefit. Getting into the right habits, getting drilled with the right habits. If the system or if your signals are set up, say, to get in, you get in without hesitation. And possibly getting into that type of mindset and that frame of structure is something that these Forex ultra mini size accounts may help you with. So that is one consideration of when and where you may want to try these ultra mini size accounts. Most Forex companies, by gosh, they offer free real-time news, real-time charts and quotes with state-of-the-art order entry platforms, and even some have automated order entry features such as the one cancels the other and a trailing stop feature. So you have everything at your disposal without any of the added additional costs that futures traders have to deal with. In futures trading, you have to pay exchange fees. You're going to have to pay for quotes separate. You don't get a free quote machine every time you're trading a futures position. So that's an additional cost to a foreign currency trader who's using futures. Forex traders, that's one of the neat benefits that's provided for you. It's kind of as you pay the difference, which is called the PIP. We'll get into that in just a minute. It's a pay-as-you-go type of methodology, and it's a better preferred way for most investors. That if I'm right in the market and I'm paying as I go along, I'm also getting the quotes and charts and getting the order entry platform along with that. So trading Forex has these benefits with it. As I just mentioned, Forex trading has no real commission, so to speak, and I quote that because some Forex companies will have you go straight to a interbank dealing desk, straight to the interbank market, and you'll pay a PIP, which is the difference between the bid and the ask, the offer, and also a small commission as a service fee for bringing you straight to the interbank market. Other foreign currency markets have what's called a dealing desk, and they are taking the other side of your trade. So when you buy, they're selling, they're lining up, matching those trades. And so some people feel that there could be a chance that there could be a wider spread involved than what is in the true marketplace. And quite frankly, depending on what bank each one of these interbank dealers go through, whether it's the big banks with JP Morgan or whether it's Citibank or whoever the banks are, the bottom line is this: you're being brought to a foreign currency marketplace, and unless you're trying to scalp for 1 or 2 pips or points, then you're missing the real essence for a speculator. A speculator is looking for probably a little bit more of a swing in the market move, possibly anywhere from an hour to possibly 24 hours of being in a trade, and you're looking to capture hopefully a large percentage of the average daily range. If, let's say, for example, in the euro currency, we have an 86 pip average daily range, at least over the last year through 2005, if you can capture just 60% of that range, you're talking close to 50 points a day. 50 pips is not a bad way of making money. That would be on a full-size 100,000 lot contract size, $500. So by using the foreign currency, it's a pay-as-you-go methodology of buying. You're paying the spread, and a lot of these spreads are really coming down now. So that's one of the neat features for foreign currency, another great feature for Forex traders. Now, futures offers transparent pricing, and I'll show you what that means at the end of our presentation. In fact, a really neat thing that we're going to borrow some of the information from futures and apply it for foreign currency trading. But one of the things about foreign currencies in versus the futures is that where futures, what I mean by the transparent pricing, we get to see on these platforms the bids and the asks, what the size, how many contracts are below the market looking to buy, how many contracts above are looking to sell. So we can see the depth of the market. They call that the dome. Another thing is that in the future, some of these platforms, and this is what I want to share with you, and I want you to really take this with you, is that they will be able to identify by either a blue or a red dot, and you can change the color on some of these platforms, where you enter the trade to help you track your performance, whether you're anticipating signals or whether you're acting on the signals. That's an important feature because I think that it's one of the exercises that I even talk about in the trading course, to print out a chart as you trade and then go back and see when I bought it, what price and what time, timestamp it, mark an X on your chart, and then you can better track your performance. Did you act on a real signal? Did you guess? Did you anticipate? Did you not trade the system correctly? And you'll be able to go back and pretty much get a progress report on how you are as a trader. Now, the futures does that. In the Forex, you can do that too, so you can monitor your progress by using some of the techniques that we use in the futures markets. Now, futures does not give you the free trading, so to speak, by bids and asks as they do in the Forex. In fact, one of the ironic things about futures is there still is a bid and the ask. You'll never be able to get in right there at the market without looking at, again, buying the offer. You're buying the offer, you're selling the bid. Generally, with any market, it's just like with buying a home. There's an asking price, and then you're a buyer coming in, probably underneath the asking price. With the Forex markets, you know there's going to be a specific spread difference if you want in. You know what you're going to pay every time. You know what you're going to sell each and every time, what that spread difference is. And so When you set up an account with a Forex dealing firm, you're going to ask, what is my PIP? What am I paying in and out of every trade? Am I paying 3, 4, 5, or 2 pips even? And some firms have now come down to tight spreads such as 2 pips on most of the majors, such as the euro currency. With futures though, besides that being transparent pricing, you're still paying fees and commissions. You're paying brokerage fees, exchange fees, and you still have to pay a brokerage commission, and you still have that bid and ask to deal with. News, quotes, and charts, those aren't free either. Those are added expenses for traders. So with the Forex, we've identified some of the more beneficial aspects of trading, and most of you may have, and you may be already trading in the Forex market, but for those who are not familiar with the Forex markets, I think this is a great introduction on differences and why I think that Forex is better in certain aspects than futures. In the spot Forex markets, all trades must be settled within 2 business days at the close of business at 5 p.m. Eastern Standard Time. Now, I bring this to your point because now we're getting into the essence of our presentation and this trading course, which brings me to my next point, and that's pivot points. That's the time period for which you should use to calculate your Forex pivot points. If the banks, institutions, hedge funds, if money is being moved around the globe and it's assigned a value or a value is given and money is moved from or credited to at 5 p.m. Eastern Standard Time, that's the time you should be considering as the close for the Forex. So when you're doing pivot points, and as we get into our pivot point section, keep in mind that's the time period we're using for the close. It's one of the most effective time periods. Now, some people say, we should use midnight because it's a new day. But and others argue that the fact that currency's trading 24 hours a day. There is no official close. Yes, but the banks assign a close at 5 p.m., so you should too. Number one. Number two, between 5 p.m. Eastern Standard Time and the time that the Asian markets open, there really isn't a lot of big market news or price influencing events that take place. So maybe you have during earnings seasons in the U.S. market, or maybe there's a geopolitical issue that occurred, or maybe there's some type of an activity around the globe that may have caused a price surge in foreign currencies against the U.S. dollar. That might occur, but by figuring out your numbers at 5 p.m., you're better prepared for the next trading session. So when does the next trading session begin? Well, 5 minutes after 5, you can assign as your open. And this is kind of important when you're looking at daily charts, because you need to have an open and you need to have a close, especially if you're using candlestick charts. The irony is everyone has a different opinion on this open close session, but yet most charting packages will have an open close based on that 5:05 p.m. And so I think that if you should learn more about trading and pivot point analysis, experiment. Use the 5 versus the 5 p.m. close versus the midnight close, and you'll find there really isn't that much difference. So once again, 5 p.m. Eastern Standard Time, that's the time on your daily charts using Forex that you should assign your close. Now, anything that happens from 5:05 until the next day, 5 p.m. Eastern Standard, anything within that time frame, the high and the low of that 24-hour session, that's the high and the low that you use for your pivot point analysis. The close would be the assigned close at 5 p.m. Eastern Standard Time. So hopefully we've covered that point well. Now, pivot points. What are they? Where do you get them? And how do you use them? Well, first off, they can be supplied or calculated either through my website, which is nationalfutures.com. Most members of my advisory service have access to this pivot point calculator. Very common. You can actually, through the Genesis plugin, this is provided for you. And in fact, the Genesis plugin has a moving average pivot point calculated. In addition to that, we're going to show you a way on how to determine the strength or weakness of a market by using the pivot point as a pivot point moving average. So this course is really going to get into very much detail about pivot points, why pivot points, or the typical price we call it, are crucial in helping to determine the market condition. whether it's bullish, bearish, or neutral. Knowing that information will help us then formulate an idea of what pivot point support and resistance numbers to use. Then, once we have that information, we therefore will look for candles and other momentum techniques that when the market gets near these support and resistance, we look to establish a trade based on the market's perception of value and, of course, the change or the direction or momentum of the market move. So pivot points is just one facet. It's in my methodology and training, and it's just one of the dimensions that we look for. And so you got to understand pivot point analysis first in order to continue forward. So they're very easy to use, and all you really need, you just need the prices, and you can use pivot points for stocks, for futures, for Forex, for pretty much any time frame. My favorite time frame is I use them for daily, weekly, and monthly time frames. Now, this is what my pivot point calculator looks like on my website. My decimal point, as you see here, is by the second decimal spot. What you do, and this would be a euro currency, is just take the market high, plug it in. So instead of going 1.2974, plug it in as 129.74. That would be the high, that would be the low, then the market close. Once you type in your figures, whether you want to do it for a day, a week, a month, a quarter, a year, then hit submit. If you want to do a market that's not covered, or if you're looking for just having not covered, at least in my advisory service, or if you're looking for an exotic cross, then you can formulate and look for your own pivot number. You have your R1, your R2, your pivot point S1 and S2. And that can be found at nationalfutures.com. That's www.nationalfutures.com. Now, pivot point analysis is which is most technical analysis is derived from mathematical calculations which were developed centuries ago. Now, Sir Isaac Newton helped develop what's now known as calculus. So we've been using math formulas, and the same ones, for several hundred years, and nothing has really changed in the aspect of how we use math to this day. In our mathematical analysis, when we're combining market numbers, or at least information from the market, what we're using are the common denominators, and that's what I call common denominators. That's what I call that each and every one of us have equal access to. And these are the open, the high, the low, and the close. Now that information right there, based on a day, a week, a month, every one of us all have equal access to that information. You know, in the old days, it was posted in the Wall Street Journal. We could see what these were. Within maybe a few pips of the spread, of course, that's what a bank would do. They'd have currency, and if you're looking at an exchange rate and you go to London, for example, on a holiday or a vacation, you would have to go to a currency exchange, literally, and convert your U.S. dollars to pounds. Now, that because of that service, they would probably take a couple, or at least a dime or 15 cents difference, or clip you for their profit involved of converting that currency for you. But again, they were passing the risk on, or at least assuming risk, because in case there was a currency devaluation, a currency exchange would take on that additional risk. So for that risk, they were charging a premium or a discount, depending if you were buying or selling a foreign currency. But needless to say, the common denominators always, in each and every one of us have access to, is considered the open, the high, the low, and the close. And that's the data we use for plotting bar charts and, of course, candlesticks. Now, pivot point analysis is a mathematical model, and it's used to project ranges and trade breakouts. Daily, weekly, and monthly time frames can be calculated, and I do use the weekly and monthly time frames. They act as a leading price indicator for traders. It's one of the best leading price indicators out there. Now, what we're looking to do is use them as a guide, a gauge, a tool to identify what the potential high or low might be in a given session. That's right, not just support and resistance, but I use them to help me identify what the potential high and low will be in a given day or a week. Now, with pivot point resistance lines, here's where a lot of traders get in trouble. The market's behavior at pivot point resistance or pivot point supports can occur differently, different ways the market reacts. Now, some people would look at a pivot point resistance and the market's breaking out of resistance and they'd go long and the market goes right back down against them. Then they'd get up and they go, oh, it's going through resistance again. It's going to go this time. And then it comes back down again. So people get a little bit anxious on what to do at pivot resistance. And that's why I said at the very beginning of the presentation, if you look for sell signals at or near resistance, you will have a better, more fruitful trading plan. Because if you look to buy breakouts of initial resistance, you're going to have probably a very hard time, as you can see in this example, that the market had bounced through the resistance back and forth, and then finally, as the market went from an uptrend, it consolidated, and then the trend went into reversal. And it all happened right here at our pivot point resistance line. Now, we have several different ways that people look at this. Market blasts through resistance, then it comes back, and then they think that resistance is support, and then they start to look to go long. Well, the bottom line is, I always like to look at in where these areas of resistance, I like to look for sell signals. So if you look for sell signals at resistance, that's why you're using the resistance and support line as a gauge or a tool or a guide to help you. When a market gets too far or advances too much in what we call an unsustainable extreme, we're looking for the market for a quick reaction. I don't care if the British pound goes to 250 to the dollar. I don't care if the euro currency goes to $1.50 to the dollar. I don't care if the Canadian dollar is parity to the US dollar. I'm not an economist. I'm a day trader. I'm trading for a living. I'm looking for shifts in the market, and I'm looking for momentum flows to capture a decent portion of the daily range out of the market that I can profit from, close my trade out, and look for another opportunity the next day. That's the true essence of trading, whether that's your plan for a day, a week, or the month. Whether you're a day trader, a swing trader, or position trader, that's truly what you're looking for as a speculator. So once again, you have to identify who and what you are as a trader. Now, if you are a speculator, that's why it's important to look at these pivot points, because as this example shows, sometimes, the market, you look to just sell at resistance, and it's looking at the price behavior. Sometimes the market can go above resistance. Sometimes the market won't quite touch the resistance. And other times, it's just so bizarre and uncanny and amazing that sometimes the market will hit the resistance exactly and then have a market reaction where we see a downside move. Now, there are other times the market gets near this pivot point resistance line and then just takes right off through it and keeps going. So you got to be able to use pivot points as a guide. It's not the holy grail. And that's one of the things that I teach, is to how to use pivot points effectively as a guide rather than relying on them as the holy grail. And I think that's what's going to help you in your trading from here on out. Now, pivot point analysis, unlike Fibonacci studies, relies on specific time frames for its analysis. The calculations that we're going to use will give you the high and the low, or both, for any given trading session. Many times we'll see the high hit, many times we'll see the low hit, but once again, a lot of times we'll see both the high and the low for a given trading session be the exact pivot point, support, and resistance numbers. The same principle goes for the weekly and monthly calculations. A lot of times we're going to see the low or the high hit for the weekly numbers sometime in the middle of the week, and a lot of times the high for the week might be, I don't know if it's going to be Tuesday or Thursday, but we're going to have a range in the week. And some days between Sunday night and Friday's close here in the U.S., we're going to have a high and a low in the market. A lot of times that high might take only 5 minutes to form. The low might only take 5 minutes to form. So if we have an idea on different time frames, higher degree time frames, such as monthly, weekly, and then daily, we have an idea that if the market gets near a potential resistance of a monthly time frame, gosh, it has to occur sometime, since there are generally 4 weeks to every month. On average, you're going to have one of those weeks make a high and one of those weeks make a low. In fact, in one of those weeks, one of those days will actually represent the high, and in one of those days, think about it, it might occur in an hour, 15 minutes, or break it down in a 5-minute time period. So if we have a way to measure or heighten our awareness of what the reality is or the potential range of a given market may be. In a month, we can break it down to a week, and then we can break it down to a day. And that'll help us stay focused and grounded when we come to making a trade decision. Now, again, I did say that we want to use 5 p.m. New York bank settlement close for the daily numbers. For the weekly calculations, let's take the open from Sunday night session and use the close on Friday. Anything that occurs during that week from the high to the low, that's going to be our values for using our pivot point weekly calculations. So anything between Sunday night that makes the high and Friday's close, and anything between Friday's close and, of course, from Sunday's close to Friday's close, from Sunday's open to Friday's close, in that time frame, those actually 5.5 days, anything that's the low in that time period will be the value for the low. So we have the high, the low, and of course Friday, real simple, we're using the 5 p.m. bank settlement time for the weekly numbers. Now, for monthly calculations, many people have asked me some really good questions on this, and they say, well, what is your month? Do you do it from the middle of the week to the middle of the same week a month from now, or what do you do? And I use calendar months. Let's stay on the same business cycle as the rest of the world, the rest of the banking system. We've got to stay in the same system that hedgers, commercials, the professionals are, and therefore we're going to be on the same time frame, and possibly we'll be in sync with the same numbers that the big guys are looking at, and that's what we want to do. Now, here's the calculation for the mathematical formula, where P equals the pivot point, C equals the close, H, of course, the high, and L for the low. Now, the pivot point number, we're going to take the high, the low, and the close. We're going to add those up together, and we're going to divide by 3. So, again, that would go like this. The pivot point is going to be the high, the low, the close. Add those up, then divide by 3, and again, that gives us our pivot point. Now, that pivot point is very important to help determine our resistance and support calculations. There are, in essence, 2 resistance numbers in pivot points and 2 support numbers. Now, to figure out R1 as it's known, or the first resistance point, we take the pivot point times 2, take that value, subtract the low of the session, and then we get R1. For the second resistance, take the pivot point number, add the high, and then subtract the low. That would look like this. Pivot plus high, subtract low, equals our R2, our resistance number 2. For the first support, take the pivot point number times 2, and then subtract the high. So that would be pivot times 2 minus the high, and that gives us S1, or support 1. For the second support, take the pivot point number, subtract the high, and then add the low. And that'll look like this. Pivot minus the high plus the low equals S2. Now, this formula is in your trading manual as well, so you have it here on this presentation and also in writing in your booklet. Now, some analysts use the calculations for determining an even larger degree price expansion prediction. And that's what pivot point calculation in essence really is. It's taking a given time frame of a given time and helping us to determine what the potential high or low or range might be for the next time period, or again, a projected expansion or extension of the prior time period's price range. So in foreign currencies, sometimes we see some very wild extreme market moves, and some people feel it's important to expand on those price ranges, and so they'll use what's called R3 and S3. In other words, a third resistance and a third support target. Here's the calculation in the formula and how you can do it yourself. For those who are computer savvy and those who are good at Excel, you can develop your own program and have this in your own Excel program. Take resistance for the R3 would be the high plus 2 times the value of the pivot, subtract from the low. For S3, take the low, subtract 2 times the value of the high minus the pivot. And that's the mysterious, the elusive, and one least talked about, the R3 and S3 calculations. Now, there are others who teach and at times the market itself will come close to the midpoint of these numbers. And so, therefore, they actually officially write down all the numbers and the midpoint of those numbers. So let's take a look at this. From R3, if we take a look at a given time frame, and then say this example, this is a bar chart. Let's say this is a day. This would be the low of the session. That would be where the session opened. That would be the high, and that would be the close. That's what that hash mark represents on a bar chart. Now, if we're using traditional pivot point, if the market closes closer to the high, remember, you're taking the high, the low, and the close, and adding them up, dividing by 3. Let's take a look at the effectiveness of the mathematical calculation of this formula. We've got two values closer to the high, the close and the high, and one down here, which is the low. By essence, if I add those 3 up and divide by 3, equally speaking, the pivot point is going to be a little bit higher than the actual midpoint of the range, right? So therefore, we're looking for an expansion of this range, and we're going to see R1, we're going to see R2, and R3 would be a way up here, a major expansion for the third resistance level. The opposite is true to the downside. If the market is truly bearish, of course, we're going to have the market have an expansion or extension of this overall range, and we'll see S1, S2, and S3. Now, if you have all these numbers and you draw the midpoint, remember, S3 midpoint, S2 midpoint, S1, then the midpoint to the pivot, then you've got the midpoint, then R1, the midpoint, then R2, then another midpoint, then R3. And I write these numbers out. That's just way too many numbers, and it can lead to information overload. And again, information overload is what we call, or can sometimes interfere with us, as it leads to analysis paralysis. And that's the term often quoted that is associated by a trader hesitating when he sees a potential opportunity. He has way too much information. So using R3 all the way down to S3 with the midpoints, that gives us 13 price levels to monitor. Now, friends, think about this. If that's just one day, and we're using weekly numbers, that gives us 13 plus 13. Now we're at 26 levels to monitor. Then if we have monthly on top of that, now we have 39 numbers in front of us to monitor each and every day. And I got news for you. I think I have found a better way of trading without that type of information overload. Now, here's my rule of thumb for pivot points and how to use them. If the market goes through my daily targeted R2 or my daily targeted S2 number, in other words, the second resistance or the second support, I use the weekly and monthly numbers to give me a better indication for the next major target level of support or resistance. Now, if we go through, as it says here, if all the above are breached, in other words, if we go through the monthly R2, the weekly R2, and the daily R2, believe me, R3 numbers aren't going to help us. In that scenario, I would incorporate longer-term Fibonacci price correction or extension studies, and we go over how to do that later in this presentation. Now, more importantly, on a normal given day with adequate liquidity, not a lot of price or news-driven price shocks to the marketplace, I initially take R1 and S1 is what I anticipate to be the potential range of a given time frame, and I do that for all my analysis. That means my daily, my weekly, my monthly. So now if you think about it, I've got 2 numbers for the day, 2 numbers for the week, 2 numbers for the month. I've got 6 numbers versus 39. So, especially I use that methodology when we're in low volume or consolidating trading sessions. Now, the pivot point. Remember the pivot point? The high, the low, the close, added up, divide by 3. That can also be used to determine the actual high or low of a given time period, especially in strong bull or strong bear market conditions. So, that's worth repeating. Let me go through it again. In an extremely bullish market condition, the pivot point, which once again is the high, the low, the close, added up, divided by 3. So the pivot point can become the target low for that trading session. In an extremely bearish market condition, the pivot point will act as the target high for that trading session. So now we have pretty much in any environment, we have 3 market direction trends or conditions. So how do we choose which pivot points to use. So far, in a normal or sideways or low volatile session, we've just discussed how to use R1 and S1 as giving us a target for what we anticipate to be the potential range. But there's three market conditions. We got a bull trend market, we got a bear trend market, we got sideways choppy market conditions. How do we choose which support and resistance numbers to use? Well, there's several methods, and we'll talk about them. There's one method that you can use to help filter out which pivot point numbers to use in your pre-trade setup process. One method is to use the close greater than the open, then you'd use S1 to R2. In other words, if the market closes above the open, the market's considered to be bullish, you'd look for S1 to R2. That would be an idea, a game plan of what to use. If the market closes below the open, then we would want to use R1 down to S2, as that would indicate a bearish market condition. I have a better way of doing things. And a more reliable method is to actually use the pivot point, which as we demonstrated earlier, remember we showed you that the high and the close, if the close is close to the high, those are two strong values. The lows, of course, the pivot point is going to be above the midpoint of that range. I went through that with you just a few moments ago. Now, if the pivot point, and this is neat, because if the close is greater or above the pivot point, we're also in a more bullish market scenario, and we should start to see a higher high and a higher low, and if that's the case, we're looking for a bull trend. After all, that's what defines a bullish trend, higher highs and higher lows. So if we're bullish, why would we look at S2? We wouldn't. We'd probably anticipate if we're going to have a bull market, and if it's going to continue, we're going to choose S1 up to R2 as our targeted range for a given trading session. Now, on the other side of the coin, if the close is less than, that's what that sign stands for, if the close is less than the pivot point, so in other words, if we close lower than the pivot point, that's giving us an indication that the market is actually in a bearish mode. And if that's the case, we'd use R1 down to S2 for determining our predetermined setup plan that the market is in a bearish mode, and we're going to look for R1 to S2 to be our potential range for that given trading session. So here's what it looks like. And again, this is in your trading manual, but I thought it'd be neat to go over and go into more detail. The graph on our right here shows us, first off, that the market is doing what? It had a very large range day. The market closed below the pivot point. Therefore, the market should be what? Bearish. And so if the market's bearish, we want to see what? We want to see the next session be lower high and a lower low, and possibly a lower closing low, or better yet, at least the market should continue to sustain that downward momentum and make a lower close than the prior time period. In other words, this market, this close here should be lower. That's if we're going to be bearish. But a good sign of a reversal is if, number one, the market closes above a prior time period's close, if the market closes above the open, but more importantly, if the market closes above its pivot point, and as an added bonus, if it closes above the prior time period's pivot point, this gives us a possible sign that we have the best bullish signal available. And so that's showing that there's a change in the momentum of the market. There's a change in the value of the market. That's a hidden sign that I look for. So if prices close above the daily pivot point, especially from that given time period, and if we close above the open, and if we close above the prior day's close, the market is considered bullish for the next time period. In this case, we would take our high, our low, and our close, and we'd look for the market to go between pivot point to S1 up to R2. We'd look for a bullish reversal sign. So that's how we can help filter out our numbers and what to expect based on price conditions in the marketplace. Now, look at this. We have a sequence of what is traditionally a bullish market. What do we have? Higher highs, right? Higher highs, higher lows, right? And another factor that's not really talked much about, and this is something I really do emphasize in my seminars. The market not only closes above its open, but notice here the market closes, see that hash mark there, above a prior time period's high. That means the market's broken out and it's closed and it is expanding into new price territory. And when a market expands into a new price territory, guess what, folks? It wants to continue to test that expansion until one of two things happen. Either demand dries up or supply increases, which is similar as the same thing. More supply, less demand. Demand may stay steady, but if there's more supply, price is going to go down. So, in a bullish environment, buying begets buying, as we say. More importantly, we see higher highs, higher lows, as you see here. That's a bullish trend, and that's very good. More importantly, we see higher closes than the prior time period high, and we see the market close above the prior close. Those are bullish trend signs. Now, what would we want to do? In that case, if we're bullish, if you think about it, if the expansion numbers to the downside, looking at our S1, our S2, and our S3, if we're in a bullish mode, the market's probably not even going to go down there. We're going to anticipate to see a higher high and a higher low, right? So we were going to probably focus on the pivot point. Imagine this. If this bar right here, if that's the high and that's the close and that's the low, if you added up those three values, the pivot point's probably somewhere above, of course, above the midpoint of that range, right? Because you have two values above the one value, which is the low. You have the close and the high. They're close to each other. So naturally, those two values, if you average them up, they're going to be up here. So if you average by 3, your pivot point's going to be closer to the midpoint, or above the midpoint, more importantly. So we're going to want to focus on the S1 to the pivot point and possibly as high as R2 in a bullish market environment. Well, let's try to focus this and narrow this down so that it's completely understood in a graphic fashion. If we took the high, the low, and the close, threw it in the computer, got our calculations, this is about exactly what it would look like as a lineup with pivot expansion, both for resistance and support. First off, the R2 number would be way up here. The R1 would be at or above the prior high. The pivot point would be slightly at or above the midpoint of that range. S1 would be above the low. S2 would be, of course, an expansion of the overall range and an expansion of the low to the downside. So S2 would be lower than the prior time period's low. So that's how pivot point analysis and the mathematical calculations works out. If we're bullish, why would we be looking at S2? So in a bullish market, we should be looking at what? Higher highs. The highs should be higher, and the lows hopefully should be higher than the preceding time period. In that environment, I use the S1 up to the pivot point for targeting what might be the low of the given session, and then I'm looking for R2 for targeting that time period's potential trading range. Why is that important to me? Because then I can, if I look at a buy signal and I get a trigger to go long sometime during the course of the day, I know that the market's only going to go so far in that given time period, and it'll help me to target a profit potential at resistance for that given time frame. So here's how I help filter out the numbers. If I'm bullish, I'm using the pivot to the S1. It might be the midpoint, it might not be the midpoint, but I know somewhere in this target zone, I'm looking for a trigger to go long. Now, I just don't go buying at pivot. I need something more, and that's where candles help me. And I have something a little bit better, which is really exciting, and that's using a pivot point moving average methodology. So for foreign currency, since it is such a trending market, the market really behaves and responds well with moving averages. So I think it's something that we need to help as a trader to put a little bit more on our side as far as a clue as to what to use, or giving us a clue as to market price strength, weakness, and that will help us to determine price direction and how long we should stay in a trade or not. All right. So how do we come down and conclude about it? We've seen ways to filter out bullish market scenarios. We've, just as a quick review, we've determined in low volatile trading sessions to use R1 down to S1. We've determined that if the close is greater than the open, to potentially use S1 up to R2. We've also determined that if the close is above the pivot point and the open and the prior time period's low or close, we want to do what? Use S1 up to R2. Now, what about the downside? Real simple. If the market closes below that time period's pivot point, we're going to be assuming the market's bearish. So in other words, if this is our pivot point and the market's closing below the pivot point, if it also closes below the prior time period's close, and if we close below the time period's open, so we have several bearish indicators. And more importantly, if the market's going to do what? Close close to the low. Those are all hints that we should be looking at a potential bearish turnaround in the market. Notice that, and that's what we're looking for. We're looking for reversals in the market. We're looking for the market to go from an uptrend. What's going to give us that trigger, that signal to go to the downtrend? And this, my friends, is that system, that methodology. We're looking for these conditional changes in the market. That's what we call them. I'm looking for the market to show me if it was truly bullish, then the market should close above the open. And we should see higher highs and higher lows. And the market, if this was truly bullish, we have that formula. We have a higher high. We have a higher low. But the market closes below what? Its close. The market closed below its pivot point. The market closed below its open. That's not a very strong bullish sign. So therefore, I would be more prone to looking for the next session for pivot to R1 all the way down to S2. And that would be how I would use the pivot point in relationship to the close to help filter out which numbers to use. Now, if you think about this, in this example here, we are what? Making lower highs, lower lows, lower closing lows. In other words, this close right there closed below that low, right? If you draw a line straight across, we've done what? We've closed below that low. So with that, and if we draw a line here, let me go through here. See that low right there? And you see the close? The close is below that low. That is a very negative, bearish situation. We have lower highs, right? Lower highs, lower highs, lower highs, and we also have lower lows. That's all very bearish. But if in this situation, why would I be bullish? Especially as we see that trend continue. And if that's the case, I got news for you. You want to be looking at what? In this case, if I'm bearish, the market closes below the open. Remember, that was one of the more simplest way of determining whether the market is truly bullish or bearish. If the market closes below the open, then you would want to filter out and use R1 to the pivot point, R1 to the pivot point, and target down to S2. But in the other methodology we've been showing you, if the market actually closes also below the pivot point and below the prior time period's close, we're definitely looking at a change in market condition, or we're looking for the market to remain bearish. And if that's the case, again, R1 to pivot down to S2, and that'll help give you a better idea of what to do when the market gets there as well. So once again, in a bearish market, the highs should be what? Lower. The lows should be lower than the preceding time period. So in that situation, in that scenario, I'm using R1 down to the pivot point to project the high, and then I'm looking for S2 for targeting the potential low for that next time period's trading range. And this is about what that would look like. If we're bearish in the market and we're looking for the trend to continue, why would I be looking for R2 way up here to target a high? If I'm bearish, what? The market should be in a downtrend. We should see what? Lower highs and lower lows. In that case, pivot up to R1, somewhere in here, we're going to be looking for a sell signal. We'll target S2 to be our potential low in a bearish market environment. So that is how we help determine and filter out. And these techniques are covered in your trading manual, but I thought that going through them by not only visually and also audio by me showing you and writing in what you can see with the close in relationship to the low is very important. And with pivot point analysis, once again, it's a guide, it's a tool, it's kind of like a handrail. You're not putting all your weight on that handrail, as you walk downstairs, but you're just using it to help your balance. Well, that's what pivot point analysis should be used for, helping you to determine a balance as to when to enter a market or exit the market. Now, one of my main focuses in using pivot points is multiple time frames. That's what I'm really known for. In fact, I'm probably one of the world's foremost authority on pivot point analysis. I've been using them for over 26 years. I've written so many articles on them for various publications, and in fact written a book. And some of you may know that there's another book coming out through John Wiley and Sons, which will talk more about pivots with ETFs and stocks and futures. And boy, I'll tell you what, there's so many different trading vehicles they work just unbelievably well with. You can apply these in pretty much any facet of investment vehicles that you're personally invested with. So I also wanted to let you know that it's not just for Forex. It just works amazingly well in foreign currency markets. But when you add up the different time periods, and since there are approximately, of course, 5 business days in every week, and since there are 4 weeks in every month, usually one day will mark within that month will mark a high, and then one day within that month will mark a low. So why wouldn't you want monthly support and resistance numbers in front of you every trading day? I understand I only have to figure them out once a month. Weekly numbers, I only have to figure them out once a week. So they're just an additive tool to help you. Time is very important. And what market opinions are made on, market opinions are also changed on in the various time periods. We might be bullish when we leave every day, and then next morning something happened, and everyone's all bullish now. So you go from bearish to bullish cycles in the market, and it happens over time as people readjust their thinking or their opinions on the perceived market value of a given product's price in a given time period. So once again, market analysis has a lot to do with not only price, but also price within a certain time period. And that's why it's important to use monthly, weekly, and daily numbers. Now, with confluences, what we're doing is we're looking for the pivot point calculations to line up within the different various time periods. So the more confluences or numbers, the coincidences, let's call them, that line up within the various time frames of the pivot point calculation values themselves. And I wanted to actually give a better description. A pivot point calculation value could be R1, R2, S1, S2. And for those, if you want to experiment with the R3 or the S3 numbers. So if there are a day, a week, a month where a lot of the same numbers coming up, pay close attention to that price level. It'll give you a stronger certainty for a market reaction off of that support or resistance number. So once again, the more confluences or corroborating number adds to the significance of a specific target area. They work to pinpoint almost exact times and prices for trades in the various markets, and they can be used to validate other analysis. Let's take a look. Not all the time will we see the monthly R1. It could be the monthly R2 or the weekly R2 or the weekly R1 or the daily R1. But if these levels, and they're not always going to be exact, but I tell you what, they'll be pretty darn close. So once again, the more the numbers line up, you'll want to heighten your awareness to that price region. And if it's resistance, you want to pay close attention to any type of a sell signal to take advantage of a major reversal. Now, let's take a look at the US dollar, Japanese yen. Now, this was kind of interesting because as I talk on Forex TV as one of their market analysts and commentaries, the market, I was telling people back in late November and early December to watch for a major reversal. And again, at the beginning of December, we had our monthly numbers, we had our weekly numbers, we had our daily numbers, and look what we had happen. The weekly resistance R1 was 121.88. The daily R1 was 121.16. The monthly number 121.04. And again, the actual high here was 121.40. So we're looking for something to give us a sell signal. Now, if the market's truly bullish, what should we see? If the market is truly bullish, what should we see? We should see a higher high, a higher low. We did. But notice here this red candle. The market closed below the open. And we're going to get into candlestick analysis and show you this. Also, notice that this candle here is what we call a doji pattern. But also, notice that the market stopped making higher highs and it started to do what? Stall. And notice that we started to make lower highs and lower lows. And then we did what? We closed below the open. We closed below prior time periods lows, thus generating a major sell signal in this market. Lo and behold, right here at our confluence of resistance. And that was quite a healthy retracement move to the downside in the Japanese yen. Those are the signals that you really want to watch for. So confluence of pivot points actually helps nails the high. It's kind of interesting. That was the exact high that day. That was the daily R1, 121.16. If you add these values up, you'll find out, and you average out the monthly, the weekly, and the daily numbers. If you average and add those up and average them out, you'll find out that you're pretty close to what? 121.40, the actual high. So looking at pivot point analysis in various time frames can help give you a clue as to potential turning points in the marketplace. Now, we don't know if market's going to come down and how it's going to react to the daily, weekly, and monthly numbers, but I just know if the market starts to test these values, we want to pay close attention. I don't know if the market's going to do what we call a traditional V bottom. A V bottom would be where we'd see the market go straight down and then straight back up. Sometimes the market can come close to those support numbers and then take off, and other times the market can chop around, kind of bottom out, maybe form what we call a rounding bottom, or sometimes we get a cup and saucer pattern where the market will kind of mess around and give us that type of pattern and then take off. Bottom line is that we want to look for clues that the market's bottoming out. More importantly, we're looking for clues and buying signals near support. Remember, buy at support, sell resistance. When we get a confluence here of various time frames, it's very important for you to understand that you're setting up and looking for a trading opportunity. Here's a neat idea or aspect in the marketplace. Also during the month of November, we had a confluence of not only daily, weekly, but monthly numbers. The monthly and weekly pivot points, and of course combined with other forms of technical analysis, help determine some really great trade signals in the Forex markets on the euro currency. Notice that the monthly S2 number is 116.90, the weekly S1 number 116.58, and the market nailed in the low for this time period. In fact, it even occurred following month, and we had better numbers and really good signals, such as higher closing highs, as we get into later in this course, for trading opportunities to the upside. Now, let's say you weren't really all that keen on buying the euro currency near the monthly or weekly support numbers. I'll tell you what and how this information can really help you as well. At least you're not going to get online and get scared and act on emotion and start selling in the hole. And selling in the hole means after the market's had a major price decline. And let's face it, if the market went from approximately 121.70 all the way back down in a little less than 4 weeks to 116.50 level, well, that's a tremendous move in a very short period of time. You may think that you're missing an opportunity and think that you should go short. But if you had the monthly and weekly numbers in front of you, you'd say to yourself, whoa, we have a confluence, we have a lineup or coinciding numbers near this area. I don't think I want to go short here. Let's just stand back and wait to see what happens in the marketplace. So it's not only sometimes using this information to act on a trading opportunity, it's It's also being able to use this information to know when not to put a trade on and which side of the market to stay on. So by using the pivot point analysis and by using confluence of various time frames, you will at least be armed with better information so that you can make better trading decisions on.